the most successful ones, and that's the first thing I say, is what is your plan and what are you trying to achieve? And let's work backwards from there.
Welcome to the Insurance Refocused podcast, where we're highlighting real agent stories and how they are innovating to respond to the changes and challenges happening in the independent insurance industry. My name's Lindsay, and I can't wait to introduce you to my amazing co-host, who just so happens to be my mom, Carey Wallace. Mom, how you doing today?
I am doing fantastic today, Lindsay. How's your day going?
It's going good, thanks.
Yeah, I am really excited. I get to invite someone that I used to see on a pretty regular basis and love working with. So today we have a good friend, Mike Wagar, who's the Senior Vice President and Agency Banking Market Leader of Westfield Bank. That's a mouthful, Mike. Wow.
Yeah, we like long titles here at Westfield Bank, so it encapsulates a lot. But yeah, it's a mouthful to say.
Yeah, well, so grateful that you were willing to come on and join us today on the podcast. Thank you so much.
Oh, my pleasure to do it, Carey. We go back, a long way, and have worked on a lot of things together, and it's my absolute pleasure to spend some time with you. So we're looking forward to our conversation.
Fantastic. Well, here's the thing. You and I have been in this industry for a while. You've probably been in it longer than me. I've been in it 16 years. And I will tell you, this past year might have been the most change I've seen in the industry in one condensed period of time than ever before. We are in this crazy post-COVID, employment situation for agents. We've got a hard market. We've got rising interest rates. We've got all kinds of stuff happening. I mean, we've got still an aging demographic. My question to you is, what's been the impact of all these forces coming together from a banking perspective? Are you seeing a rise? Are you seeing a decline? Are you seeing any change?
Yeah, I tell you, there's been no dull moments the last 3 years, Carey. I mean, starting with COVID, and when COVID hit, we were starting to at the, I guess, what I would call the rush of a lot of transactions. You start to see a lot of perpetuation, a lot of acquisitions going on. Then COVID hit, and everybody hits the brakes and goes, "Okay, what's going to happen now?" And then everyone took a breath. We did PPP loans, which kept us very busy for a couple months, and then it picked right back up where it left off, right, from an acquisition and perpetuation standpoint. But we were dealing with the challenges of remote work and doing Teams or Zoom calls all the time, which, you kind of reserve those, at least we did before COVID, for like the special occasion, or we just can't get together. So we'll do this as a last resort because we prefer to be in person. And now it's become part of our everyday, activity in doing that. And so you've got that. You've got a far more mobile workforce. There's been a lot of changeover in a lot of industries. Insurance and banking, certainly are right there with it. But in 2020 and 2021 were two of the most busy and the most activity in M&A and perpetuation that this industry has ever seen. I mean, the percentage of turnover and the percentage of people, and I think if you looked at maybe the root causes, I think there was a few things that kind of came together to really ramp that up. It was, you had a very low interest rate environment at the time. In general, insurance and insurance agencies didn't feel brunt of effect of COVID from a financial standpoint. They all performed pretty well. And then you had, what's still an aging demographic who said, maybe it's time for me to exit because all these external things going on, I've just had enough. And then you have on that side, then you have in the buy side, lots of cheap money out there, lots of appetite for acquisition, lots of things going on. And so you put that together and there's an explosion of activity. So 2020 and 2021 were record-breaking years, and 2022 backed off a little bit, but still pretty robust. And then we get into mid-22, and you start to see interest rates coming up, and some more economic turmoil is going on. And throughout 2023 so far, that has been even more exacerbated with what's going on. What I've seen happen in the industry at this point is private equity, who had been predominantly the buyers in a lot of these things, has actually slowed down a little bit. They're still there. They're still prevalent. But I was at a conference in January this year. We were talking about the impacts of interest rate increases and these things. And you've seen a lot of private equity firms who are relatively new to the space, who recently got capital raises, was really cheap when they got it. And now the cost of that capital was going up and it was putting some of them on the sidelines. And I saw it as an opportunity for the independent to get back in the game, right? There are so many independent agencies who just didn't want to, nor should they compete with crazy high multiples and deals of private equity. And they were on the sidelines naturally. And this has given them an opportunity to come back in. And we've seen a tremendous uptick in activity from the independents now jumping back into the game and acquiring people. Certainly, borrowing costs are higher than they used to be, and they may be for an extended period of time. But I've yet to find a deal or a case where someone has decided not to do a deal because of the interest rate environment at this point.
It's funny that you say that because I think a lot of buyers think that they needed to compete with private equity, which is impossible, by the way. If you're using a bank loan, unless you've got a balance sheet to pay a crazy amount down, there's no possible way you can do that. But the reality is not all sellers want to sell to a private equity organization. I mean, and not all sellers are even a fit for private equity. So I think it's really interesting that you said that because you shouldn't compete. You should know what your value proposition is and how you fit with the buyer and what they want, because there's so many buyers out there that say, you know what I want? The price is not the most important thing to me. What's most important is I want to take care of the people that helped me get here. I want to take care of my customers. I want a seamless transaction. And then I want the highest price when I think of those things, or I want the name to stay the same, or I want the location to stay. There's lots of things that are important to people. And sometimes when it's a private equity, those things are different. Like the outcome of that transaction are far different, right?
100%, 100%. And whenever I start a conversation with an agent about this process, I say, from a sales standpoint, and even if you're a buyer talking to a seller, you have to. There's really three big questions that they have to get answered on where the right fit is for them, and it's what do you want? So you mentioned that. What are you looking for? When do you want it? So when is your transition time? And then lastly, how do you want it? Meaning, do you want all cash up front? Do you want the absolute top dollar? Do you want your people to stay there? Do you want your name on the door? There's value to all that stuff. Do you want to get paid out over time? So there's all those different features that go into it. And you're 100% right. Private equity is not a fit for everybody. There's not necessarily a wrong answer, but you are totally correct in that if you're an independent agency trying to compete with a PE buyer, I don't think that's appropriate. They're paying high multiples because they are going to slash all the overhead and they can fold it in and they can afford to do that. Where with an independent firm, there's a lot of more, you're buying talent, you're buying, some name recognition. Those things are important. And there's a price with that too.
Hey guys, if you're looking to improve your bottom line, allow your team to operate efficiently, and really improve that customer retention, I believe you should check out Ascend. Ascend is the all-in-one insurance payment solution. They are focused on streamlining your invoicing, premium financing, accounting, and they'll even make your carrier payables for you. They are taking agency bill and making it as easy as direct bill. That is a game changer. They integrate with all of the major AMS players, and here's the best part. It's free. There is no subscription, no cost to you. They allow your customers to pay how they want. If you are interested in improving your efficiency, go visit ascend.com/insurance refocused and let them know that we sent you.
I know a lot of agencies that are turning over right now are multi-generational family agencies. So when those types of situations come to you, what advice would you give them, or what's the kind of the process for that to happen?
Well, a lot is planning, Lindsay. So, you can never start planning early enough for these transitions. We all too often see someone who says, I'm ready to retire, and there's been no perpetuation plan in place. And then those conversations with that next generation haven't occurred, or they've been very high level. And they may not be prepared to do that, to buy into it and take that on, or they may not want to do that. And then that's where that ends up being that outside sale. But I think the ones that are the most successful are there's been a multi-year plan and a multi-year conversation in place with this is how this is going to work. We're going to ease you into it. We see programs where the next generation buys small chunks at a time so they can, walk before you run with some of that and not make it too onerous, because the hardest time for a buyer is that very first year you buy, right? You have a new debt or you have a new payment to make. And yes, there's more money coming in the form of distributions, but it's a whole new world of being an owner versus being a producer or something like, or even just a high level manager. So that first year is the toughest. And if there's not a good plan in place for how that transitions over time, it can get pretty challenging. So the most successful ones, and that's the first thing I say, is what is your plan and what are you trying to achieve? And let's work backwards from there, either from a financing standpoint. And as bankers, we sometimes play consultants too, right? We're holding hands along and talking through a lot of different scenarios. And so we try and work with them really closely to say, let's figure out where you want to end up and we'll get you there. We'll help give you some ideas and some ways to structure these things, both from a finance and a tax standpoint. And then really most importantly, from a culture standpoint. Are you ready to step up and be the leader? Are you ready to take on those other things that go along with that?
So that's huge, Mike, because if internal and in particular, sometimes the exiting owner wants to stay for a period of time and continue to play a role in the agency. There's someone internally stepping up, which means you've got to backfill what that person's doing. Talk to a little bit about the reality of what that means to the exiting owner, the incoming owner, and the health of the agency in order to satisfy that loan. That I think some people don't think through that. They just think, I know agencies sell for this amount, therefore my agency is going to sell for this amount. But those kinds of decisions make a huge impact on what kind of loan and what kind of price and what kind of time frame and all those good things. Can you walk through that a little bit and just
Sure.
simplify that whole thought process?
Well, I'll start with this comment. We've done over $1 billion of loans to agencies since the bank has been in this space, and the bank's 23 years old, really focusing on insurance agencies for most of that time. But we have yet to see 2 carbon copy deals. Right? Because although there are 40,000 independent agents in the country, there are 40,000 different companies, different cultures, different ways of management, different specializations. And so because of that, it's a very unique thing. And so I think you mentioned it right on. If you have a next generation or a producer who's stepping up to ownership, there's got to be that dynamic built into place with the outgoing owner who's willing to take a step back a little bit. You have to give that next owner the runway to run it the way they see fit. And if it's a gradual transition, that's okay. Those tend to work pretty good sometimes because that new owner can learn and shadow the outgoing owner or the one who's taking a step back, rely on their experience, rely on that. And then also the backfilling portion is key. So if you're the agency's top producer and now you're going to become an owner, are you still going to produce? Or do you have the capacity to produce your book and run your book full time and manage the agency, or can you have the talent behind you and the bench strength to delegate some of those things? Those are some of the growing pains that kind of go with that. And even from a financial standpoint, the tax implications of having the debt and what that means to you. And if you're an owner, the distributions you're taking because you have to pay tax on the income of the company and all those different pieces, parts that we try and get out in front of with that in that process, but it takes time. So that goes back to having a plan in place of this is how this is going to work. We've identified who the buyer or buyers are. We know they're going to take on additional responsibility, and here's how their current responsibilities are going to be handled. So that's really important to do, and those are the questions we ask. In the lending business, I mean, numbers are numbers, and they're very important, but the story is equally as important in our view, because we want to understand what your plan is, how you plan to grow, how you plan to take it from A to B. And then, we view it as a partnership. It's not merely just a transaction. And so our intention is that if we make one loan to an agency, we want to make several loans to them over time, where as they keep perpetuating, have new producers coming in, finding new owners, making acquisitions. And so we really try and form that partnership and get to know them and have them get to know us as well. So that planning process is an ongoing conversation.
It's interesting that you say that, because I think, at least in my line of work, someone comes to me because there's a reason. And I think for the same thing for you, like they come to you because there's an imminent transition or there's an imminent thing that they need to do. And sometimes it's not too late, but you wish that they would have come earlier. So the fact that you have agencies that you have relationships with, tell me the difference in dynamic of lending to someone that you've got a relationship, you understand their business, all of that, versus someone that you're just meeting. Like what are some things that are different in that dynamic, that if you could tell the ones that have never met a banker before, they've never actually gone through the loan process, what they should know in order to make that go better? What? Yeah.
Yeah, great question. So someone that we're working with for the first time, or if this is the first time that they have talked to a bank or done anything like this from a business standpoint, there's a lot of education that go involved. We talk to them and ask them to tell us your story, give us your elevator speech, tell us about you and your agency and what your plans are, and then we want to share the same story, because I think it's equally important on the borrower side to know who they're partnering with. Here's what we're about, and here's what we do. And so there's usually a longer courting process, if you will, because we're trying to get to know each other and see, is this a good fit? I mean, there have been situations where we've had conversations and it's not been a good fit or a good timing for whatever reason, and that's okay. Nothing is permanent as far as that goes, but it just may not be the right time. So there's a lot of the education, a lot of get to knowing, relationship building, and you want to establish that trust. And I think the most important thing to do that is you have to establish your credibility and the trust on both sides. And in other words, we need to demonstrate to the agency that this is not our first rodeo, and we've been down this path before. We know your business, we understand how this works, so you don't have to educate us on this. Consequently, we want to hear from them. Are they prepared to be an agency principal? Are they prepared to go to the next step? Are they prepared to execute on the plans that they've drawn up? And so we've got to have that trust that's very mutual. Whereas if you have an existing relationship, those conversations are happening frequently. I think that's the biggest difference. We look at our larger clients and the ones we interact with the most, we're communicating on a frequent basis via text, phone, email, whatever it may be. And oftentimes we set up just quarterly meetings just to have those conversations of, hey, what's going on? And what are you seeing out there? And do you have any challenges going on? And we tell them how the bank is doing. And oftentimes it gets into a very exciting economic conversation about what's going on. So it's that ongoing dialogue. And that's a really key thing.
How long does, and I'm sorry if you said this, I might have missed it, but how long does it take for someone who comes to you and wants to buy an agency, but maybe never has before? Like, how long does that relationship building piece take?
Well, it's all over the board, as you might imagine, right? Because no
Yeah.
transactions are the same. There are some that, you have very well qualified buyers. They have a plan in place. They're ready to go. And we can turn in 30 to 60 days, depending on different circumstances. There are some where it's a year plus of conversation because they're just starting to get prepared to do those things. And it's oftentimes a longer cycle because they are trying to get the right pieces in place, both financially, culturally, organizationally, to be ready to do that. So it can go really, really fast sometimes, and it can be 1-2 years, even longer in some cases. I mean, I can think of a case where we worked with somebody for 3 years before the transaction happened, just because there was so many moving pieces, parts, and it was establishing that trust and that rapport and that relationship. So
Yeah. And when someone does approach you, um, whether you know them or not, do you guys require like some sort of business plan outline of, this is where I'm taking the agency, this is what I'm planning to do? Is that part of the process as well?
yeah, we yes and no, and the only reason I hesitate is that it largely depends on what they're looking to accomplish. If it's a brand new firm or a newer firm and they say we want to grow by X percentage in the next 5 years, then we'll give us a plan. Let's talk through how you plan to achieve that. In some cases, it is, here's our story. We want to accomplish, A and B. We've got it in our sights. We've got it well defined. And so it's not necessarily a formal business plan as a requirement. It's really a very much case by case. However, I would say that in our conversations and as we start to work with somebody, we talk about those business plans and what they are. And it may not be as formally documented in every case, but we're having those conversations.
If you're like me and many other small businesses across the country where hiring, training, and retaining employees is a challenge, Agency VA has a solution for you. Agency VA has over 1,000 VAs hired, managed, and trained in the Philippines, Latin America, and India. But did you also know they have 100 licensed agents here in the US that can help you manage your book? I use a VA who lives in the Philippines, and I absolutely love her. The process was simple. We had a consultation where they asked me my needs, goals, and concerns, and matched me with Allie, who has been an absolute game changer for me. Employing Allie through Agency VA has allowed me to focus on my business without worrying about HR concerns, turnover, and monitoring payroll. The best part is the Agency VA team was eager to help my company and also make sure that Allie is getting employee benefits, a competitive salary to help her live a better life in the Philippines. If this is something that you are struggling with inside your agency, please visit Agency VA /Insurance Refocused and set up a time to talk to them about your hiring needs. So, Mike, I got to tell you, I get asked that timing question all the time. Like, if someone wants to sell their agency, how long does it take? If someone wants to buy an agency, how long is this going to take? I also think it matters when they reach out in the process. So they can think they're all the way down the line and they could have agreed on a price. They could have agreed on this. And then they go to lending and the lender says, sorry, not quite, because we aren't going to underwrite that much, or you need a larger down payment, or whatever it is. Like, you guys are an integral part of that plan. I think it also matters when they engage certain people to make sure to make that go smoothly. Wouldn't you agree with that?
Totally. We've had cases where we've had to have some hard conversations with borrowers. They've signed an LOI. We want to close in 2 weeks, and look, it's just not realistic. Not just from our side. We need time to underwrite and get things through, but have you engaged your attorney? There's legal documents you need to engage, and your accountant, have those tax conversations. So to me, sometimes it's a bit of a red flag if they want to go too quick. So it makes me question, have they done the right amount of diligence? Do they have their ducks in a row? So usually I recommend is get your advisors involved as early as possible. We don't necessarily need to be involved as you're going out and finding potential acquisition targets or what that would be. I mean, that's one part. But if you're having that conversation, say, hey, I think I may have something, then that's the time to engage your advisor team. And they can answer a lot of questions of, what do you need from me to evaluate this? Again, on all sides, how long do you think it will take? And I think it depends on, I think it's important to engage early and often.
100%. So listen, I know none of us have a crystal ball, right? And we talked about why 2022, had a huge uptick, in my opinion. Honestly, 2023, I have more people now that I think have positioned themselves well to say, I'm ready to buy. And there's a lot of people saying this hard market is a lot. I've had transition on my team. And honestly, I'm worried that this might be also the high. Everybody's worried that this might be the high and things are going to go down. Which is interesting because multiples have done nothing but grow over the past, certainly since I've been paying attention to multiples in this industry, they've grown from a private equity standpoint. But if you had a crystal ball and you were looking to 2024, 2025, what do you think is going to happen in the marketplace, and what should people expect to have happen?
Yeah. Well, I always say my crystal ball is foggy, so I'll give it my best go here. So I think we're going to be in a prolonged higher interest rate environment. The economic forecasts, which we pay a lot of attention to, have been changing early and often. For a while we were thinking there would be more interest rate increases, now I think that is questionable. They may just remain flat. Everything that we've kind of read and what we're preparing for is there's a possibility of another hike or two, maybe from a Fed standpoint, but then I think it's going to stay up for a while. And then you might see some of it backing down from a rate environment in late 24 into 25. But I would be shocked if it would decrease at the rate it went up. I think the Fed is really, uh, trying to manage inflation. That's their number one goal. And barring any catastrophic events, I think the interest rate environment will be higher for longer. And to that point, people hear rates where they are right now, and they're like, "Wow, that's really high," But we've been spoiled by 2% and 4% mortgages and low lending rate environments for a long, long time. And so even if you're in the 7 and 8s, and from a commercial loan standpoint, in the grand scheme of things, it's still pretty good. If you look over a long period of time, it feels high now compared to where we've been, but I think we'll be in a higher rate environment for a while. From a multiple standpoint, the economic policy would tell you that if you have high interest rates, that sales multiples would have to come down. We've not seen that. If anything, they've come up a little bit. There's still a ton of demand for well-run insurance agencies. If you look at insurance, it's a very resilient business economically. If you look through the last 60 years, through recessions or other catastrophic events, it's performed pretty well. Now we're in a hard market with I would say, a wild weather probably environment for the last couple of years, and how that plays out will certainly be interesting to see if that continues. But I don't foresee a huge change in the environment from a multiple standpoint, or really an activity standpoint. If anything, especially third quarter and into the fourth quarter of 23, we've seen an increase in activity right now, and I think we're going to be seeing that for the next few years.
It's super interesting when I present on this and I show them the trends of multiples and all that good stuff. I always get the question of, do you think that this is a high? Like, is now the time? First of all, the time has to be right for a lot of different reasons, not necessarily just where interest rates are or where multiples are or whatever. And you shouldn't go past your time. Like, if you're asking yourself that, you should be planning and figuring out what you need to do, because in every other part of our world, we know intellectually that we should buy low and sell high. But in this industry, because we have this renewable income and it's very, very predictable, some people stay past it and they end up buying or selling low rather than selling high. So I think if someone's asking those questions, I think they know the answer, that it's probably time to start thinking about that and start planning. So here's a question that I get often, because interest rates are now higher than what they've been. A lot of people are shifting back to, well, maybe I should do an owner finance loan or a combination of that. They want to get super creative. My thoughts on owner finance loans are, I love that Thanksgiving dinner remains happy and pleasant among a family. And I would strongly suggest don't play the bank to someone and have your retirement dependent on them being able to run your agency, especially as the marketplace is changing. We've got this hard market. Like, it's not your grandfather's agency anymore. Like, there's a lot of pressure. Tell me your thoughts on the combination. Let's say there's going to be an owner finance loan for the down payment. There's going to be a piece of that. Tell me what's the real, if someone's thinking that in their mind, tell me what the bank's perspective is on multiple lending sources and all of that.
I think a combination lending is really good. I really like it, and for the reason of this. Sometimes, again, that first year of buying in is the toughest time, right? So having a combination of cash up front for the seller, hey, that's probably attractive for the seller. But then also having that secondary note with them tells me that they're engaged and they're interested in making sure that this succeeds. So having that seller carry some paper, it can be beneficial for the buyer, but they're also then committed to making sure that this transition is going to go well. I'm going to make sure that they don't fail, because my repayment obviously is dependent on that, but also B, I've got a lot of sweat equity built up in this agency. I'm willing to play bank for a little while just to make sure it goes well, and I'm going to make sure that I'm going to do my best to make it go well. So I really like that because it keeps everyone engaged and kind of around the table. I do think certainly, if a seller is willing to do things at really cheap terms and they're okay getting that there's some things to be said for that. But I think it's if you look from a seller standpoint, they're typically when they're selling a portion, they're giving up some compensation from a salary standpoint, and so getting some cash up front helps them kind of replace some of that compensation. Paying a little tax, no one likes to do it. It's not the worst thing in the world. Paying a little tax on that, and you can kind of stretch that out over time. So I think a structure like that is really good. Even in an acquisition, I would sometimes get concerned if the seller says, "Hey, I want all my cash up front and I'm gone in 30 days." To me, it's like, well, what are you running from? So that gives me a little caution, and that's far from a blanket statement because again, everything is different. But having even a seller carry a note for a certain period of time, whether it's a year or two, again, just to keep them engaged in the transition of the accounts and the culture and the employees if they're sticking around, I think that's a really smart thing to do on both sides.
I would agree. If it's not a win-win-win, there's something wrong with the deal. Like that's the reality. If it's super lopsided to one or another, it's bound to have some serious challenges without question, right?
Yeah. And if you talk about, what's the fair deal? Someone told me this early on in my banking career. The fair deal is when the buyer thinks they paid too much and the seller thinks they sold for too little. That means that's a fair deal.
So to wrap up, I would love to talk a little bit about people who are coming in and are potential owners, potentially who are younger generations. What are you seeing them do that is helping them be really successful at in this market right now?
I I think the one thing that I've been impressed with when you have younger buyers coming in is their adoption of technology. And I know that sounds like a very cliche statement to say, but think of the technology enhancement that our industry has seen in the last 5 years, in the last 3 years. Almost every carrier now is involved in data analytics of some sort, and they want to make sure that not only they're providing the agency the right amount of data, but the agency is giving them the right amount of data too. So I think there's been a good mindset shift in that owner, that those younger owners coming in to make sure that the technology is up to date and the technology is attractive for the insured, for the end user. Is it easy to process a policy change? If I get a new car, how easy is that to do? We all have a lot of self-service from our phones and computers all the time, and so making sure that they've are up to speed on that. But then the flip side is not losing touch of what got them there in the first place. I still think there's been a lot to be said for people buying, their car insurance from a company online that there's nothing there and they're doing it at 3 in the morning. There's certainly a demographic for that. I think everyone wants a person to go to if you're a consumer, right? Everyone wants a guy or girl to call when they need something. And I think the value of an independent agent, specifically with, some higher end personal lines, certainly with small business commercial lines, having that personal touch, the accessibility, the responsiveness is huge. And that's a differentiator. And so as those buyers are preparing to come in and do that, the next generation, they've really lived up to that mantra. They've really embraced that. And it's taking the agency to another level.
No doubt. If you think technology and data is replacing a relationship, you've never had a claim. That's what I will tell you, because there's no way
That's
in
right.
the world I want to be on an automated call with someone if I've got an emergency. I want to talk to a person that I know, like, and trust, who cares about my family. And I could not agree with you more, Mike. Oh, my goodness. Well, I am so thankful that you came on and spent some time with us. If any of our listeners wanted to reach out and talk to you about anything, like being a partner with Westfield Bank, if they need a loan, all of that good stuff, how can they find you?
Yep. So our website is an easy way. It's westfield-bank.com. All of our contact information's on there. You can email me. It's mikewagar@westfield-bank.com. Call me direct. We've got a team. Really proud of our team. We've grown. We have 6 people on the team who do nothing but work with independent agents from a banking standpoint. They know the industry, and they're eager and willing to help out. So we've got a great team here and a great organization, and I think you'll be really pleased if you reach out with your experience.
Awesome. Well, thank you so much for joining us today.
Thank you so much for having me, Carey and Lindsay. It was my pleasure. Great to see you guys as always. You guys do a fantastic job. What you provide to agents out there is second to none, and you guys do an awesome job, and keep it going.
Thanks so much for tuning in to the Insurance Refocused podcast. If you enjoyed the episode, please be sure to hit subscribe and leave us a review so you'll never miss us. Want to learn more about how Agency Focus can help you grow your agency? Head to agency-focus.com or email Carey directly at carey@agency-focus.com. If you need to get in touch with me, feel free to shoot me an email at lindsay@agency-focus.com. Thanks so much for tuning in. We'll see you next week.